Good morning, traders. Welcome to the TMT Stock Market Strategy video for Tuesday, January 3rd. So I hope everybody enjoyed their holiday season. It is coming to an end, winding down. Today is the first day of the trading of 2017, and I think it's going to be very, very exciting, guys. There's going to be a lot of unknowns, but I also think that the markets are going to really start to move one way or the other, but we've had a lot of consolidation in 2016, the back end of 2016, from July all the way till just about October. We consolidated for 4 months within ranges, and then we, of course, broke out of a Trump rally, and now we're at these extreme highs. So we're going to talk about that in this video. We're going to cover the indices, and we're going to cover some indicators, and I'm going to put out 2 separate videos, one on crude oil, detailed analysis, and one on gold as well. And of course, we will cover the US dollar because it does affect the commodity price. So look for those videos right after these videos. I've been working on it all weekend, and I'd like to start off the new year with some big videos on some real good research on crude oil, gold, and of course the indices and where we go from here. All right, so let's get right to it. So please make sure you look at that at our YouTube channel, and of course you can go on to tradingmarkettechnicals.com and click on the videos, and you'll see the videos there as well. All right, so what I want to start covering, I want to cover some volatility, which we really have none, right? So that means that we have some extreme complacency, and I want to show you this chart, which is the AAII, and it's the bullish monthly chart, right? So it measures the sentiment of what is really going on in the markets, right? We close at all-time highs of 2016. Now, I mean 2016. We never closed at all-time highs, but you could see in 2016 we've closed at its highs. Okay, consumer confidence is, I believe, hit a 6-year high. I think it was a reading last week or the week before. Okay, so why am I telling you this? Well, I'm building up to something, and I want to just show you. Let's get right to the next one. Average true range, great gauge of volatility. We have none. There is none. Right, it's down at 14. When markets get fearful, volatility expands, average true ranges expand. So right now we have none. So we're at almost at the lows, if not, well, I would say near the lows. Okay, that's also another red flag. All right, now this isn't a video to scare anybody or to do anything like that at all. We are trend traders at TMT, and we trade what we see. We follow the trend, but we have to also put out a word to use caution going into 2017. Here is the VIX, right, the volatility index. Now, we had no real tax selling, guys, going into the end of 2016. We had really virtually none, other than the last trading day. Okay, now I do think that you might get a day or two of a pop, but remember, a lot of hedge funds, a lot of other fund managers, if you will, did not sell. We really did not have a selling season, tax selling season at the end of the month. So that tells me is that, if anything, I would be looking for a pullback in January, where the tax selling, where a lot of these managers clean their book up from 2016 positions and start fresh at one point in January. So I'm looking for a move lower, and we'll see that move lower happens, because we could go into a correction, we could go into a pullback, but we don't know until that move happens. Okay, not saying it's going to happen today. All I'm saying is be on the lookout. You'll know when you start seeing the markets can't rally anymore. They pop up and then they fail, and they start to reverse. That's going to be your cue as a trader to start setting up some new trades. Now, going into 2017, we are going to have a shift of rotation in a lot of these sectors. That what was working in 2016 is probably not going to work in 2017. Why? Well, the number one thing, we have obviously a new president. That's number one. Number two, we have an interest rate rising environment where we have to position as traders. We have to reposition for that. Okay. We also have low volatility going into 2017. We have market prices at 28 times forward price earnings, which is extremely expensive. So you have to wonder, are we ever going to get a pullback? Well, since 2009, we haven't had a 15 to 20% correction since then. And that's just, it's way overdue, it's way overdone. I could see it in the cards. Can I see it happen? No, I don't know exactly when. that is only going to be measured by pullbacks. When we get pullbacks, we measure the severity of the pullback by volume. There's a lot of other things as technicians that we look at to get a good handle on. Well, this is just all noise. 2 to 3% is all noise, but once you start getting into some deeper areas and start breaking some key levels, that pullback turns into a correction. And we don't know that until it happens. If somebody else is telling you that, run away from them because they have no idea. Okay, so just getting here into the VIX, we have very little, very low volatility. And even at 14, yeah, we had a big move up for 3 days because we had a pullback, but that's really nothing. And we're at the upper end of the band. We'll probably rally today, tomorrow, and maybe even Thursday. Who knows? But the thing is that watch, because we have low. The purpose of that chart and other charts is that we're showing you that we have low volatility. When you have extreme low volatility and you have extreme consumer confidence and we have extremes in price, you have to be careful wondering that we're probably going to get a decent pullback. Here's the advanced decline with volume. As you guys know, you've seen this chart many times, and this is really all you need to look at is right here. Okay, it's all you need to look at, guys. This is the area. Look where we excelled. Real fast. I think too fast. And what happened? We made that high. We made the high here, and then look what happened. Now we're making lower highs here. So, not to me personally. This is something that kind of scares me, especially when I see something like this. That the breadth of the market is not internally cooperating with price. Okay, price is what pays us, but you also have to say risk off happens extremely fast. So again, another red flag. Doesn't mean you can't be buying pullbacks today. It just tells you for the longer term, the swing trader, the long-term investor, I do believe, from based on what I'm seeing technically, you'll be able to add to your positions at much lower prices, and especially not at 28 times forward earnings. Next is bullish percent. SPX is based on a point and figure chart. So the S&P is at 70% on buy signals right now, and you can see here we had this little whipsaw. We have a nice little move lower. We had the move break lower here. We had a little whipsaw here, break. I didn't put all the lines because I just wanted to kind of show you guys that we are right now on this little thumbnail cross back down again. Okay, I like to see this take out this little area here at 69.5. That'll confirm that in part of our TMT trading model that we are on a sell signal. Not there yet. We still haven't gotten there. We still need a couple of more indicators in our model to go on a sell signal before we can actually call a sell in our model. Next is going to be our indices. I want to just show you the weekly chart. Nothing wrong with this at all, guys. I mean, it's very, very positive, very bullish, right? Lower lows and lower highs. Had a double bottom here, and now we're making higher highs and higher lows. Okay, so that's nothing wrong with that except that we're extended, and you can see here on our moving average is 219.71. Trading at 223, and our TMT proprietary price channels are way down below at 216. Okay, so just something to keep an eye on, but nothing wrong with the weekly chart or weekly chart is absolutely bullish. To alleviate any type of selling pressure, you need to take out this swing low here, this local swing low at 208.18. If that gets taken out on a weekly closing basis, okay, then you'll have your other pivot low here, and then obviously here. So you're going to have three areas. But ultimately, to really break this uptrend, you need to take out this double bottom area here of 181, which is way, way away. So there's a lot of work that needs to be done. But I also wanted to point out there's a lot of support on the weekly charts, okay? Next is going to be the Spiders Daily. And you can see here we're back into our big bearish rise and wedge. And 217 is going to be the first line in the sand for to really start to elevate and start breaking down here. Now, I put a Fibonacci retracement here, and I want to show you real quick here, right up in there. Okay, so there's a 38%, fills that gap, small little gap area, coincides nicely with price. Fibonacci retracements with the price itself and the gap. So really there's going to be that first line of sand, which that'll take out the 50-day moving average as well. So once that's taken out, start looking for the 217.5. That'll coincide nicely with that 76.8% retracement. Remember, there's that gap area. Eventually all gaps get filled, guys. There is one here, and there's one way down below here at 204. So at one point, we don't know when, but just keep an eye on spiders here. Starting a nice little pullback would absolutely be healthy for the markets. Here's a 60-minute view. Just wanted to show you we have no positive divergence as of yet, and we did break that critical 225 area, 224.75, 224.50 if you will. And even if we back to it, this is an area here that I'm looking for failure on the S&P 60-minute chart. Okay, IWM weekly, same thing. You could see here, big move, actually a ridiculous move off of a Trump rally, and now we're way down below here. And then of course our proprietary price channel. So we're looking for our first spot here, just cover that small gap, and then of course down here at 124.56 and 120.69. All right, but nothing wrong with this chart at all, other than just that it's a little bit extended. So the revision to the mean trade should be intact here. We start taking out this Friday's low on the IWM weekly. Next is the IWM daily, and as I pointed out, we had an M top formation here, higher low from this previous low. Here's your neckline, still has not broken down from the neckline of 135. We take that out, we should hit the 38% retracement real nicely. That'll coincide nicely with this uptrend line. Okay, so that's gonna pretty much do it. And if it does get down there and we get below this proprietary price channel, that's going to solidify that we should have a bigger move to come to the downside. Okay, and you can see our MACD and RSI really telling us that momentum is waning, and we're still holding up here. So another sign to just to use caution here at the moment. Lastly is the Qs. Nothing really to say about this chart. Looking really good, really constructive. We're above the above the 21 EMA. Above the TMT proprietary price channel, so there's nothing wrong with that, making higher highs and higher lows. Just want to show you clean price. Nothing wrong with this at all. Daily chart looks a little different. We did have that bull flag that we broke out of. The next day we failed miserably, and now we're back below it. So I'm looking for a breakdown of this lower trend line, and then next stop will be our swing low pivot of 115.15. All right, so that's it for our indices. I know it is a little long, but a couple other videos that I'm doing are going to be a little bit longer as well, because I want to get full market analysis. We do have some exciting news to come. Have a lot of requests that we're trying to accommodate a lot of people for our technical analysis video. So wait for the coming days. We're going to be making announcements soon. Have a great day, everybody. Crude oil and gold will be coming up next, so look for that on our Twitter feed. Take care.